Yashpal Gupta joins us, Managing Director and CEO of Repco Home Finance, to take conversation forward. Mr. Gupta, good morning. Thank you for joining us. Real estate sector is in a downturn. The non-salaried class, which was your large client base, is feeling the heat of the slowdown. What is happening to your business? And in this environment where, I won't use the word gloom and doom, but when sentiments are not exactly running high, how is business been for you?
Okay, good morning. See, no doubt the real estate sector is facing certain problems and non-salary sector are facing more problems, you are right. But business has slowed down, but it has not been as bad as it appears. What we have done is also we are using this opportunity to tighten our credit norms so that the quality is improving while quantity may be slowing down. But of course, it is not as bad as it appears. As I told you, we are quite confident. As you see, September to September, we achieved 11% growth rate on book size, which is quite good. And for the entire year, our guidance remains 12 to 15%. So while it is slowing down, but it is not as bad as it appears.
How are you assessing the funding environment currently as well? Are funding costs coming down? How's your borrowing mix shaping up as well, given various sources currently? How are things looking?
As far as funding cost is concerned, in last year for Q2 our cost was around 8.5%. It went up in Q3 and Q4 of last year and also Q1 of this year to around 8.8%. But fortunately, in the last quarter, Q2 of this financial year, we have got sanctions of 3,000 crores from various banks. They are all big banks, both private sector as well as public sector. So our cost of funds has again come down to 8.5%. CPs are still available at say 7.5, 7.6%. But yes, because of listing issues, we are going slow on that. But the funding cost has come down in this financial year. And liquidity for us is not a problem anymore.
Wanted to understand whether or not you have any exposure to wholesale real estate, because all the notes that we've been going through, most analysts are actually talking about the fact that most investor concerns around HFCs, around NBFCs don't actually apply to you.
You are absolutely right. In fact, that is what differentiates us from most of the other HFCs and NBFCs, that our book is 100% retail book with average book ticket size of 14 lakhs, and we have zero exposure to companies, whether private limited companies, whether public limited companies. Our exposure is only to individual borrowers. So that is why we are better off than others. While it does pose a challenge on the book growth because tickets are very small, and we have to do large number of proposals, unlike the real estate wholesale borrowers where you can give 100, 200 crores in one go. So it affects our book size, but at the same time it reduces the risk, and second, it improves the quality. So you are absolutely right. That is our USP.
Banks have also been reluctant in passing on rate cuts. Given this, what's your outlook on margins as well? Are you able to pass on increased cost to customers?
Yes, because see, what we do is that we also lend, all our loans are floating rate loans. So we do a system of calculating benchmark rate, which is called MLR, minimum lending rate, which we calculate every month, which is function of our cost of funds, cost of equity and operating cost. So as and when the cost goes up, the rates are passed on. As and when costs go down, the reduction is also passed on. In fact, I'll just tell you, we started it in April 2018. That time our first MLR was 8.6%. Then it went up to 9.85% in March. So we were able to pass on 1.25% increase in 1 year. Then again it has come down to 9.6. As of today, it is 9.6. And sorry, 9.25. So we are quite hopeful of passing on both ups and downs. And in the last few months, our costs are going down actually, because our borrowings are from banks are also their MCLR linked. And as you know, most of the banks have reduced the MCLR in last few months, even though the reduction is not as high as the repo rate reduction, but still there is some reduction.
Reserve Bank of India has not cut rates. Wholesale borrowing rates, as per the 10-year paper, they are between 6 to 7%. That's the government bond yield. So do you think the scope of interest rate cut coming down is not going to be there? And if the scope for interest rate or lower monetary rates is not going to be there, that automatically will delay recovery further?
See, as far as the long-term rates are concerned, there my view is that because they are linked to inflation, they are linked to government fiscal deficit, and at the current scenario, with the inflation slightly inching up, I don't see repo rate coming down further significantly. It may come down by 0.25%, which RBI was expected to do this time, they have not done. So we don't see significant rate cut because on the one hand, don't forget that Indian public is majorly savers. And unless the government reduces the rate on other saving schemes like PPF, post office and all that, which will be difficult given the composition of the Indian population, we don't see further rate cut on the bond papers as you are telling. But there is scope for rate cut on the bank lending because banks still, if you see, their spreads are lower not because their rates are lower, but because of the high NPS and where they are not earning anything. If you see the CASA cost or the cost of funds for most of the banks in the range of 5%, 5.5%, whereas they are still lending at around 8%, 8.5%. So I see there is some scope of reduction on the bank lending rates. There may not be scope for reduction in the repo rate or government bonds, but I still see there is some scope for reduction in the bank rates. So I feel 50 to 100 BPS reduction can still happen without changing the repo rate and the FD rates.
So I'm going to get one closing comment from you. In this environment, when banks do have access to lower cost and banks are trying to muscle their strength with better interest rates, how do you think you will be able to protect your market share?
Yeah, that's a very good question. We cannot compete with the banks on the ROI because banks are our lenders. Banks can lend directly to the customers also. So what we have done from the beginning is that we are segregating the customer base. Like for example, we concentrate more on informal sector, non-salaried class, in undocumented income. Banks are generally reluctant to touch that. Second is that our ticket size, as I told you, is low. Average is 14 lakhs. We give 10 lakhs, 12 lakhs, 20 lakhs, which again banks are reluctant to do. Third is the service speed and quality. With banks will ask for opening of their bank accounts and so many other requirements they have, cross-selling, this, that. Whereas we go to the customer house and we sanction the loan without any such requirements. So I feel for next few years, that market still remain open to us without much competition from banks. On the higher side segment, that is 50 lakhs and above, competition has started. We are facing challenges from banks, not only in terms of new business, but also they are taking over aggressively our existing loans. But by reducing the ticket size and concentrating more on informal sector, we are able to keep competition away. That is what I see is the way forward.
Thanks for joining us this morning and talking us through the latest there, Yashpal Gupta of Repco Home Finance on the business outlook going forward.